Hello, everyone, and welcome to this panel. I think it's going to be a very interesting discussion today on the intersection of TradFi and crypto. We've got a great lineup of panelists here to talk with us about that. And over the course of the session, we're going to think about a few different things. And I was given this sort of title for the talk, and when I was given this title, I started to think about what do we mean by intersection here, and how actually do these two worlds interact. And I kind of came across the idea that sometimes they interact in a very complementary way. So, for instance, crypto as an asset class, another string in the bow for asset managers. Sometimes they interact in a sort of way where it allows you to enable more products to be given. But in other cases, it's more of a disruptive kind of interaction and intersection, either where crypto is just building alternatives that will eventually replace traditional finance, or crypto is building direct competitors to some of the things that are used today. So throughout the next just under 45 minutes, we are going to explore some of those themes and start thinking about what we're seeing happening now, what's going to happen in the future, where the challenges lie, and some of the exciting sort of future opportunities for those things. Before we get into that, I thought it would be good for me to just give you a little bit of an intro to myself and a little bit of a discussion about some of the things that we're doing to sort of give you my perspective. I'm one of the founders of Vega Protocol, which is effectively a new layer one, which operates as a kind of scaling layer or an infrastructure layer for trading, particularly around derivatives, but actually derivatives are the most complex products, so once you've solved derivatives, you can kind of enable pretty much all of the trading. And Vega was designed sort of as an intersection of crypto and TradFi itself, actually. So I worked in traditional finance for most of my career up to before starting Vega. I'd built and designed matching engines for stock exchanges. I'd worked in and with derivatives trading desks, with risk desks, and so I'd had a big exposure to the traditional system, but I'd also was a computer scientist who was into privacy and crypto and cypherpunk stuff and whatever else. And so I was super excited by Bitcoin. I was mining some Bitcoin. I was getting involved in some of the early Ethereum stuff. And I thought it was going to be really interesting to see if Bitcoin is the future of money, or if Bitcoin and tokens and everything else are the future of money, what's the future of the financial system? And the other question you can ask yourself is there any point decentralizing money if you don't decentralize trading and derivatives and everything else? And the answer I came to was no. It doesn't really help you. You don't get very far if it's the only thing you do is decentralize the money, because most of the financial system, and we're all forced to participate in that system. It's not a system we can opt out of. Most of it is not just the money, it's the things around it. So I actually got involved as that kind of intersection myself, with the intention of building something that was not, let's look at 1 year at a time, 2 years' time, let's try and just make money out of crypto, degens, whatever. It was actually the intention of building something that could one day replace the traditional finance systems I'd previously worked on. And the goal was to be able to go back to the traders that I was working with in desks in the city and in New York and say, hey, this product is serious and this product is something you could use. And the goal is to eventually be able to get there and not be laughed out of the room by those traders for what we've built. So Vega really started on that same intersection. We are about to launch the first restricted mainnet, which is a kind of governance network being launched by a decentralized set of validators, and hopefully by the end of the year or roughly thereabouts, that will migrate into a network which allows the first trading of instruments and stuff on that network in a completely decentralized way. So a super exciting time for us, and a super sort of appropriate topic given the current timing, both for us but also I think for the industry as well. There are a huge amount of opportunities. Finance is this system, as I said, that we're all forced to participate in, and I think creating a system that, if we're forced to participate in it, creating a system that treats us all equally and gives everyone the opportunity to help it innovate and grow and is not maintained by gatekeepers, is going to be a wonderful thing to do. So this is a great introduction here, and I think the things I'd love to see us talk about and get out of this are some of those discussions about those different intersections, how they work, what the challenges are, and where we think all of this is going. And so with that, I'm going to open up with a question which I think a lot of people have said to me the leading thing right now for institutional involvement in crypto is the discussion of what are the clients asking for, what are the customers on the ground demanding, because I think some of the institutions are quite cautious, but also they want to keep their clients happy. So with that, I'm going to hand over to the panelists and ask everyone to maybe give a quick intro, a little bit on their own position, and then perhaps answer that question, what are your clients asking for today?
Which end do you want to start at?
Either end. Who wants to go first?
I'm happy to start. Hi, I'm Seth Gins. I'm one of the managing partners at CoinFund. We are a crypto asset manager that has both venture and liquid activities. Kind of our roots were in early stage venture. Back in 2015, we just raised our third early stage venture fund this spring. I run our hedge fund, which is primarily in liquid crypto assets. We launched that in February of last year. We launched an NFT fund, which is structured as a holdco, in September. And we're about to come to market with a growth equity fund, so late stage venture. So really cover the full waterfront of crypto investing, 22 people, and very, very deep focus on really operational excellence, as well as having a full functional research team. My background is actually public equities investing. So I was a large cap growth investor for 18 years at Jennison Associates in New York. Got into crypto in 2012 through my angel investing. So I was an angel in Coinbase. And then for the next 8 years, it was watching, going to developer conferences, meeting investors, figuring out if and when this was going to become an institutional asset class, because I would want to launch a fund when that timing came together. Saw that coming together in 2019 with the intersection of infrastructure for custody and the derivatives ecosystem for risk management. And joined CoinFund at the beginning of 20. To answer your question, I think what we're hearing from institutions right now is they're looking to capture the asymmetry of the return potential. Now, obviously, we're a bunch of directional funds, and if we had kind of market neutral, I'm sure we would be hearing that interest as well. There's very broad interest in the space. There's a belief that we're going through a secular de-risking right now, like Tesla in 2013, like Netflix around original content, where you have a big step up in prices across the asset class, and you don't tend to look back. So a lot of people trying to quickly pull together IDD, ODD, internal competencies, and get ready to allocate in the areas that really resonate most with their practices.
I guess I'll go next. Yeah, hi, I'm Schmidt. I'm head of strategy for Talos. Yeah, my background previously ran the crypto team at Goldman Sachs, and then before that was a hedge fund portfolio manager for quantitative equities for about 10 years. And then before that, I was sort of always interested in decentralized stuff, and I worked at a company called LimeWire, which was a sort of Napster equivalent, was an early developer there. So that was sort of decentralization before we had decentralized money, so the business models were harder. And then, yeah, Talos is a software company, in essence. We are a crypto trading platform, and the goal is for many different types of participants in the crypto ecosystem to come to this portal, this fabric, sort of plug in their services, as well as consume other people's services. So we try to manage the end-to-end workflow of the entire trading lifecycle. So everything from pre-trade to actual trading to actual post-trade. In particular, if you're doing OTC, you actually have post-trade settlements in crypto. We're based in New York. We are global, though. We are very much a decentralized company. We have, I think, employees in maybe 10 countries now, about 30 overall.
So I'm Itay Tuchman. I run Citi's global foreign exchange business, so we are the biggest FX bank in the world. And I've been with Citi longer than I would want to admit. I started at the bank when I was 19 years old. I've lived in a bunch of different countries. I've had a bunch of different roles in traditional finance. I was out for a couple of years. We can talk about that over a coffee or a beer. But I want to answer the question really about what our clients are coming to big banks. And I will just say, like, this is Citi's view, but as somebody central to that client conversation, I have a lot of them. And we have, on the order of magnitude, tens to hundreds of thousands of institutional clients that deal with us, considering the scale that we operate across 80 countries where we have a dealing room, and I have people there. And it really started just with Bitcoin. But, I mean, that's the honest answer. Clients came and said, particularly institutionally, around March, April last year at the peak of the pandemic to say the store of value narrative on Bitcoin is a believable narrative. I have nothing in that narrative. Can you help? How do I get access to a marketplace? Now, if you think about what kind of clients we're talking about, if you are a family office, ultra high net worth individual, the minute you had that narrative, you can just act. You don't manage what I call OPM. OPM is a central problem of the ecology, which is when you manage other people's money, it's a different standard. The way you act, the standards and governance you need, brings clients like that to a bank like ours and says, can you help us with the problem of accessing beta in crypto, particularly through the store of value narrative. The most inspiring thing about that whole thing is how quickly that narrative changed. It was almost instantaneously a narrative about investing in crypto ecology and decentralized networks and a different kind of financial architecture and future. It became a technology, an innovation investment conversation within about a millisecond. As everybody knows who's in crypto, like that, you start with Bitcoin and you're down the rabbit hole very, very quickly. And so for us, like, what do clients ask us for? Well, only for the pieces that fit a bank operating in the penumbra of a crypto environment that's already extraordinarily robust. And what are those pieces? Things like governance, risk control, so that they can go to their investors and say, hey, we have a blue chip custodian that has a 200-year brand that I know that if something goes wrong, they will make us whole. They will stand by us, right? And I think it's notable, for example, in the institutional ecology that no large bank has its own branded crypto custodian under its own brand and balance sheet yet. But that's what customers come and ask for. They also ask for us to abstract liquidity and to say, for us to set up a trading business that can manage and deal across all the things, for example, that Justin's business lets people do. It's very difficult. You already have pipes to us, you already have documentation, you already have ISDAs, you already have these things that we need because we manage money on behalf of pension funds and institutional investors. Can you help us with that? That's the second. And the third thing that I would love to dig in further later is really about the rail of money, things like stablecoin environment. Can we get more efficient about fiat, actually, versus to be more efficient about accessing decentralized networks? And the feeling that when we get safety and soundness around the stablecoin environment and appropriate regulation and governance, can banks help make that a more efficient process versus traditional processes in fiat? So plenty to unpack.
Yeah, so my name is Swen. I work for State Street, and unfortunately, Itay just stole my thunder because my opening line was, we're a 200-year-old bank and we have the pedigree in custody, so that's where we started. Yeah. But there's a point to this. When we started a couple of years ago to getting serious about digital assets, and we've always looked at this, like I guess most banks, very much from a technology perspective, what would mean, how can you deploy that? But over the years, really then flipping this around the way we should do it, really looking first at what are the business problems. So like we would run any other business. We never start with what's the technology first and how do I apply it, but you go the other way around. And I think it was a bit of a learning for all the banks that we do, we have to approach it in the same way. We have clients that get crypto exposure from various means. There are some that actually acquire Bitcoin directly or any other asset for that matter. But I would say that's the smallest part. There's a lot of exposure at the moment, particularly from the more regulated institution investors, getting exposure through futures, that kind of structure, as well as investments through ETPs, ETFs. And in a way, it's easy because it flows through the normal pipes in terms of trading on a traditional exchange and then being custodied as a normal instrument. But also from a regulatory perspective, it's much easier. A lot of regulated fund structures like UCITS in Europe, 40 Act funds in the US probably cannot right now invest in crypto because it would not be an eligible investment for those institutions. So we see, if you want, the digital asset investments really come more from the alternatives, asset owners, and I like your point around sort of self-managed persons or private wealth type of organization being there first. The key thing I think is sort of the, if you want, how these assets entering to before you then also changes a little bit how you have to think about basically your entire governance risk control framework. And that's, I think, something that on the one hand side, institutional investors asking for. So the idea is, if I were to appoint a bank like State Street, we have been doing custody, as I said, for 200 years, and to be honest, we don't do anything else. Yes, we do risk management, we do the asset management side as well, but our focus and reason to exist is really managing assets. That's all we do. And so the expectation is, if we were to do it, it should be better, it should be safer, it should be more cost effective. And that is nicely said, but obviously it's a complex task to do that, given the market structure around us. So there are things like, if you trade on a number of exchanges, you don't really have transparency around your counterparties. There's no matching processes. Boris, who talked earlier, the pre-funding requirements. So there's a lot of market structural issues that are absent from the traditional centralized marketplace, and just plugging in a bank who is regulated doesn't solve for that. So we have to actually engage with market structures. And that's really what I find interesting at the moment, that when we're talking about intersection, it's not just we coming with our expectations and the crypto market with their expectation, but I think both have to adjust and adopt to make that work for the institutional investor.
Awesome. Thank you, everyone. I think that was really interesting, and it set something off in my mind where I started to think about the difference between the word intersection and exposure. And we're here to talk about the intersection of these two things, but almost entirely so far, the only intersection we've identified is that traditional finance is interested in giving people exposure to what they want. And I think that's probably sort of the customer service driven or customer service led approach, which sort of says naturally these people are defensive and cautious about this stuff, and possibly even if it starts to get big, threatened by it as an alternative. And so really the place where we start to get this intersection happening is around exposure, because clients are saying, I want exposure to this. But the intersection of these things actually, people will start off saying, I want exposure to this asset class, and then they will say, I want access to this product or service. And then they will say, I want to use these things. And then they will say, I want my bank account to have a public key. And so that sort of sets up to me this sort of interesting question of what is holding back from going from this sort of exposure to integration and access?
I mean, maybe I'll start, but guys chime in. I think the answer is a lot, right? And first, to your point, we're in the business of serving our customers' needs. We are not Tesla, which is in the business of inventing things that customers will want in the future that they don't even know they want yet. And so we are very responsive, and that's our core mission, is to be responsive to the things that our customers are asking for. So that's, what do you say, it's a feature of TradFi, not a bug. That's the way that we operate. In respect of your question about, sort of how that develops and what's holding us back, I mean, everybody talks about regulation, obviously, so it's the big elephant in the room. And banks, it's not just that we're regulated, it's that we stand for safety and soundness in the financial system. I'll give you an example. So I run an FX electronic business that's as big as anything in the world. If we have a single outage, that has any meaningful impact on clients, it's a regulatory event. It's an event that requires a ton of governance, a ton of notice. It isn't like what you tend to see in crypto, which even the biggest is okay, these things do happen. And we just kind of accept them as crypto people that they happen. Our customer base has an expectation that they don't happen, and our regulators have an expectation that they don't happen. So part of what's holding back is that. It's not just the regulators say, slow down on this product, or you can't do X, or you can't do Y. But for us to add value to our customer base, we have to add value in an environment that has the standards that we would expect from safety and soundness. The other thing is this question about what's a moat, what's a windmill, what's an opportunity. I really don't see that in TradFi. I think a lot of people from the outside see that we think it's threatening our business models and therefore we don't want to engage. I mean, I think there's a lot of BS in that comment. The reality is that banks are not natural participants in an ecology that evolved from retail and is now pulling itself into the institutional environment, and our job is to go slow. And I think most people like me feel like it's not a first to the post, in technology, it's first to the post. Your Ethereum, you're first to the post, right? In what we do, it's not first to the post. It's actually the person who can do it in the right way, the way that Sven was mentioning, that really wraps the customer in the cotton wool that they're asking for.
Yeah. Can I just say one thing? Sorry, there's one point, and I mostly agree with you. Just with one thing, it's if this is one of the few areas, and maybe that's why I would say the TradFi struggles a bit. If I just ask my biggest clients, what do you want? They may not necessarily be able to say, I want this. They may want it in years' time, but so you have to change a little bit, I think, how we develop products, and that's what I'm doing, right? I'm thinking about future requirements, and I'm saying, what is it that clients want, and how do I deliver on this? And typically what we do, voice of the customer, ask, tell me what you want, I build it for you. We're very good at that. But now I have to say, I have a hunch, I have a conviction, and I can only be directional correct. And that's something that is more VC type of work, and is not traditionally what you do in a large, complex organization. But I think that's why intersection is so important, and what we're trying to do, and we also stood up a new business division, States for Digital. It's like, I need to engage with fintech and the innovation where it comes from, and then be able to take that innovation in-house without necessarily building it all ourselves. So I agree with you, but also, as a result of that, I think we also have to work differently, and for me, this is a real intersection. We're learning, actually, from the crypto world how to approach these business problems.
That's really, really interesting points there, and I think a couple of things I want to pick up on. I certainly see and take the point around stability and around going slow in a way. I think that's something that relates to the kind of the maturity of the industry and the maturity of the technology, and actually, Bitcoin, you could argue, maybe is even already there. It's been around for a decade or more and has effectively no outage. So, Bitcoin maybe is already there. And then you listen to Robert Leshner talk about things like compound. It's like, we want to be boring. We want to become dull. And that is right. And Vega is kind of in a similar place. Like, we are evolving rapidly over probably the next 2 or 3 years, but the goal is to become boring in infrastructure and the kind of thing that actually that can get into that conversation about going slow and actually becoming infrastructure. It's just probably the early stage of the technology. So I think that's a really interesting thing. And then I guess the other thought that I have here is that one of the things that can be interesting is that if you're not sort of going out and inventing the things that people don't know they want yet, sometimes when there's a generational change in technology, what that means is that someone else goes and does that, and suddenly a bunch of the things you thought you could rely on in terms of business disappear out from under you. And I think I was talking to Seth a little bit before the session about some of his ideas around equity and stuff, and I think that was one of these sort of cases where there are some things we can sort of see potentially happening that come as quite a surprise to traditional finance at this sort of intersection, and actually become a land grab where people suddenly latch onto this technology. I don't know if you want to expand on some of those ideas.
Yeah, and there are a few things that I'll quickly touch on as well. So when we look at valuations for borrow-lend protocols, there's definitely a component of time in market. There's a temporal axis to valuation of borrow-lend protocols, which is very much that trust and the fact that it's been in market. Obviously, for crypto, it's on the order of months rather than decades or centuries, but we actually see that as a quantifiable valuation factor, which is quite interesting. The second thing that I'll quickly touch on more broadly and then go to where you're going, Barney, is on the cadence of innovation in crypto, because this is open source, open competition, and global. The cadence of innovation is just off the charts relative to anything that I've seen in the investment world. I was investing in the most innovative large cap equities. I mean, much slower cadence of innovation. That was on a quarterly or annual time frame. I also have a big angel portfolio. That's like very highly innovative companies, but much slower cadence of innovation than crypto, where if there's a hack, everyone immediately sees what the vulnerability was. They check their code bases and they fix it right away. Like you don't have that in the traditional world. And you get a hardening of security. You get an introduction of feature richness that just like the cadence is non-existent in the traditional world, or it's very much niche. To the kind of tangent that Barney was referencing, we think a lot about what the future of equities is likely to look like. I actually had a CIO ask me, he said, bonds are the new cash, equities are the new bonds, and crypto is the new equities. And he's like, what is the future of equities? And I said, look, I think the future of equities is equities on crypto rails. And that sounds like pretty boring at first glance, right? So you're talking about T+0 settlement, yeah, that's great. 24/7 trading, yeah, that's great. But then you start to think about what you can do with peer-to-peer equities. And just like humor me on like what a peer-to-peer equity environment would look like, but my contention is at a high level, if you have, take a Uniswap, but you have KYC in the wallets, and you have market surveillance through a Chainalysis, CipherTrace, Elliptic, you essentially have a securities venue. You have the raw materials for a securities venue where you could be peer-to-peer in your interaction. So imagine if a retailer on Black Friday wanted to attract shoppers 8 a.m. to noon, and they said, come in 8 a.m. to noon on Black Friday, we'll give you 10% back in our equity for shopping during those hours. And you get into really interesting stakeholder blurring dynamics, right? Because then that shopper is going to say, well, do I want to go and shop at the startup retailer that has this cool concept that has 50 boxes and they're doubling their store count every year? Or do I want to shop at Walmart that's growing earnings 15% a year, 10 to 15% a year? And the ownership dynamic of that rebate starts to play into their consumer or their customer decision. And you can kind of take this to the next level where you say, okay, so what does Walmart do in response to that? Well, they have to start thinking about regionalizing their business. I don't know if people remember tracking stocks from back in the day, but you could imagine starting to have tokens tied to different parts of the business, where you could have higher growth rates. You could have them be more attractive from an appreciation perspective. All of these businesses start to get much more responsive to their customer needs, because guess what? If you say, come and buy the new PlayStation at our store on Saturday afternoon, and you run out of inventory, all of your customers are going to be dumping your stock at 1 p.m. on Saturday afternoon, and you're going to be scrambling. So there's a really interesting blurring of stakeholder lines, new responsiveness that comes into play. And the last thing that I'll say here is on the startup side, if you imagine that like Elon did his autonomous ride-sharing network, and he said, we're going to give 10% back, and imagine he did it as a new company, and he said, we're going to give 10% back in equity in the new business for everyone that purchases rides, and if you contribute your autonomous Tesla into the network, every minute that you're in the network, you'll get a little bit of equity. How quickly would that network trounce Uber and Lyft in any geography where it's operating? Everyone would want to get equity exposure. Day one, everyone would want their friends to get that exposure. They'd want to build up the network. And if you think about it from the startup side, they're going from these discrete valuation step-ups where they raise capital, burn that capital down over time, don't get credit while they're burning that capital for their customer acquisition, for the network effects, and then they get a step up for their next raise. Imagine them now doing that on a continuous basis. Right? And as they get their network effects, their valuation just skyrockets on Uniswap right away. So some really interesting dynamics. And the cool thread through all this is that it's basically what's happening in DeFi today, but it's just doing it with equities, doing it with equity tokens. And I think we're a half a step away from being able to enable that.
Awesome. Thank you for sharing that. And the reason I brought this up after our conversation was because sometimes it's really hard to imagine what this thing is that sort of flips that intersectional view of it's what the clients want, we're moving slowly, and becomes the thing where the clients are somewhere else, and now it's actually the traditional finance that needs to move back to where the clients are. And I think what this does is present a compelling vision for one thing that doesn't require technology that doesn't exist. Even the KYC rails and stuff are being built and kind of they exist to an extent. They're maybe not widely deployed. They're maybe not widely integrated as sort of DeFi primitives yet. But I think, as you say, half a step rather than 3 steps. And so that presents a very compelling view to me. And I think the interesting question there is, like, as more and more areas of finance that people are involved in start to open up in that way, as they start to change and as these opportunities start to arrive, how does traditional finance respond to that, and how does the intersection evolve once there's demand for more than just this exposure for things like that?
Maybe just 1 or 2 comments on this, and for also some of the technology solutions like Talos can also help in making this happen then over time. I like that vision, It's just regulatory-wise, poor. Imagine you drive on the Uber car, and every time you do that, you get a little equity, subscription. That would be today regulated activities. The problem we see this all over at the moment. So it's not that traditional finance is intentionally boring. We are subject to very significant regulation. Itay, you mentioned resiliency in terms of what's the standard, what we held accountable versus the others, but also the kind of products and where they can be distributed. So the fact, like in Europe, best execution, you need to be very certain that is this an appropriate product for that investor, otherwise you cannot distribute that. And in a way, what we're saying is, with crypto, I'm making this all a bit more loose. So we may like this, a regulator may not like it to the same extent. And I don't think we have a good new balance, or the equilibrium, how this would be settled going forward. But nevertheless, I think it's important to say, in a way, this is what we're trying to do. So for me, the future of digital is not we're buying a Bitcoin, we're printing off our private key, and we hodl. Okay, maybe, but what we're trying to do is we're trying to organize economic exchange in a different way, in a decentralized way, peer-to-peer. Big believer in this. We're doing this already with our traditional channels, and I just think digital assets will accelerate this. But then I need to have, if you want, a technology stack that actually allows me to be nimble, to work with all of these different protocols. And in a way, and I hear this all the time, particularly when you talk about security tokens, at this stage of the process, it's a bit more complex. It's a bit more difficult, it's a bit more less integrated. So every time I go to a crypto conference, everyone's talking about the death of Swift, etc. There's a good reason for ISO standards to exist that drives machine processing, and I don't have that same level of standardization in the digital world, and I will need that in order to deliver exactly on some of these models. And that's for me a real issue. I like that vision. That's why we're in the game. Crypto is a use case. The bigger thing is kind of we can re-architect economies and the society that comes along with that. But I think we're quite far away from this in terms of making it a reality.
Yeah, I think that's a really good observation. I think obviously we all sort of it's come up a few times, the regulation sort of elephant in the room, and I think something I've been thinking about there is certainly with the infrastructure bill in the States recently, one of the things that happened on the crypto side is a huge mobilization of people who suddenly realize they've got a lot of money, they've got a lot of power, there are a lot of them, and they can get listened to. And I've seen this change over the last few months in quite a big way. Something I'm interested in is on the traditional side, actually what's the intersection between how crypto is approaching, trying to lobby for and deal with the evolving regulatory situation in crypto, and how TradFi is thinking about that as well. Like, are the traditional finance firms also going to the regulators saying, you need to sort this out, we want to play here, we want to do these things, we think this vision that Seth has created is a good one? Or are the traditional firms going and saying, actually, we're happy to say we have concerns because it suits our business and it keeps things out of these competitive alternatives?
So I suspect I am the most heavily regulated person in this room. I suspect. I'm not certain, but I suspect.
You didn't see my ankle bracelet?
No, I don't.
That's a different type of regulation.
And of course, the way that a big, heavily regulated institution or anyone approaches a regulator is with an extreme amount of consideration and caution, right? And the reality is, because ultimately, and this is a post-financial crisis world, it is not crypto that caused this. It is the global financial crisis that caused this, right? The regulatory stakeholder in his organization, my organization, and I think increasingly in a lot of, again, when I use the word persons, capital P persons, not a DeFi protocol. You can't regulate a car or the internet or a code base. You can only regulate a capital P person, a human being or a corporate institution incorporated by the law. And the challenge is, I think the regulators have been catching up, not just the regulated. And part of that is the understanding that they know that they will have to engage in this conversation. And we talk about service providers and central counterparties like ourselves and regulated, but investors are heavily regulated too, participants are heavily regulated too, and they have to think about that. So this is a journey I think everybody is coming to. Again, I can just tell you from my personal experience, as much as there is a moat which is created for TradFi by regulation, right? I mean, there's a reason why banks don't go by each other all over the place and consolidate anymore. that doesn't seem to me in the conversations I'm in to be really that relevant, I'll be honest. It's more about, we want to do this in a way that makes sense. Okay, when you talk about the tokenized rail of fiat, like one of my core intersection is, crypto is going to come out of the crypto world into the real world in a very big way, but fiat and crypto will live together for some period of time. Maybe my adult life might be faster than that. Who knows? We can have that debate. How do these things coexist in a way that is enabling both to perform the function? So how does a vendor in Nigeria who actually wants to take fiat get that on a rail that is unlocked by the technologies and efficiencies that we all are here like wowed by and love and spend a lot of time learning and understanding? And that is a conversation which intersects technology, business models, and a regulatory environment. And I think everybody is just learning, including the regulators. That's what I see.
Yeah, I think that's again a very good point, and I think we often forget that the regulators don't necessarily know what they're doing, even though every time they talk to the capital P person they're regulating, they have to pretend that they do. So it's definitely something I think where that's evolving too, and I think something we've seen is traditional finance starting to get more involved in the asset exposure to the asset classes. I think they've probably been slower to get involved in the kind of the regulatory conversation. Like you say, maybe they're a bit more cautious, maybe they have to be very careful. Since the financial crisis, certainly I remember the way banks were talking to regulators about CDOs prior to the financial crisis. I wish they would talk to regulators about crypto like that now. But certainly that's a really good point there. I was just going to sort of hand over to Justin, if you have any points, any sort of points on any of this, just want to round out the conversation before we open up maybe to a few questions from the floor.
Sure. Yeah, I mean, I obviously enjoying the conversation tremendously. I think there's sort of a lot of like non-intersection of crypto and TradFi that we probably could talk about too, where there isn't that much actual intersection. And I think one of the things that really differentiates crypto and TradFi is really culture. And the trad and TradFi obviously means traditional, but I think a lot of the crypto people are a little bit younger, and they really don't understand how really conservative a lot of traditional finance is, particularly in terms of risk-taking. And when regulators or large financial institutions like banks and broker-dealers come in and look at this space, they primarily do a risk analysis, right? So they look at market risk. Obviously, sort of crypto prices go all over the place. That's probably not that big of a deal. They're used to prices going up and down. There's operational risk, there's tech risk, and there's obviously reputational risk. And I think reputational risk is one of the most prominent things that is still to be worked on. I think in a lot of ways, the crypto ecosystem has made a ton of progress on operational risk, on tech risk, et cetera. Like the infrastructure that we have now is so much better than in 2017 when the institutions first tried to take a look at crypto and we're like, oh my God, what is going on here? And in 2021, I think the entire ecosystem has made great strides in just making all that be much more mature. But also at the same time, like crypto is quite different, right? Like I literally just had my picture taken with an alpaca, like out there. It's like super, like it's fun, right? I think crypto is meant to be fun. I think part of that fun is that you can move fast and break things. If you are a systemic large organization, you don't have the luxury of moving fast and breaking things because that's what the regulators really care about. The regulators really care about systemic risk and things that are so large that if things go wrong, that people get really materially affected. So I think we will continue to see the intersection of crypto and TradFi grow. I do think if you're a personal investor, and there are a lot of various different types of clients, right? A very common mistake is to talk about clients as like one monolithic thing when they're actually very nuanced and have very different wants and needs and demands. If you're waiting to get into crypto, say by waiting for your traditional financial institution to offer you a market access product that is like highly regulated, you might have missed a huge part of the run-up. And one of the things that crypto brings the potential of, which is very disruptive, very interesting, very challenging from a regulatory perspective, is in many ways you can be your own bank. You can custody your own tokens, you can move them around, you can annihilate them accidentally. This happens, but it's more personal responsibility. But also at the same time, from more of an asset management perspective, with crypto, you're able to get into some of these assets and invest in them at much earlier stages than you would be in the normal life cycle of an investable asset if you're waiting around for, say, a traditional IPO to come onto the market. So those are sort of my thoughts.
Can I say one quick thing while we're waiting for questions? Just on your point, I totally agree with what Justin was laying out. And Barney, to your point about the regulatory environment around the infrastructure bill in the US, I think that was one of the most important moments in crypto history. I think we cannot overemphasize how important that infrastructure bill debate was as a pivotal moment in the regulatory trajectory, where you had bipartisan senior senators saying, crypto is about technology, crypto is about innovation, it's here to stay, we need to keep it onshore. And even though the negative language around crypto stayed in the infrastructure bill, like the awareness and engagement was accomplished. And you saw Senator Toomey, when the PBOC banned crypto a week and a half ago, Senator Toomey tweeted, crypto and Bitcoin are about democracy and freedom. So this is the ranking Republican on the banking committee. So like that, in my view, is one of the biggest de-risking events for the space. Any regulatory mandate that comes out of Congress is now going to be colored by the engagement that came from that.
Yeah, even in the past week or so, and not to be the two Americans in London talking about American politics, but
I agree. I mean,
both the the leader of the Fed and the leader of the SEC both have come out recently saying, we're not going to ban crypto like broadly, which is.
And I think the other thing that's been interesting there was at one point more than half the mining was in China for Bitcoin. So Bitcoin was an agent of the China Communist Party. China has cracked down, and so now you've lost that potential narrative against it, and that's been a huge benefit as well. The other thing that, just before we open up to questions, that I thought when the comment a second ago that you made, Justin, which I totally agree, like a lot of people in crypto are young and don't understand how conservative traditional finance is. Something that made me think about the kind of generational cultural shift that's going on in finance is I can turn that around and go, a lot of people in traditional finance are old, and they don't understand how the young think about money and how the next generation of their customers think about risk. And that's probably true of both traditional finance and regulators, and this is one of the reasons why it's so hard to get right, and the reasons why it's going to be very interesting, because you have the old guard want to make money out of this and want to offer products to clients and make money, and the new guard want to replace the old guard and see them die. Like, not all of them, but realistically, there's a lot of people in the community who think and act like that in terms of building products and getting it out there. They don't really care whether the bank exists because they want these products and these things, and they're super passionate about it. And that is an interesting kind of cultural thing, and maybe it goes away as this stuff matures, or maybe it stays a kind of a vein throughout some of this as we go forward. And with that, I'd like to open up. We've probably got time for 2 or 3 questions if we're quick. I think there are some mics around.
Yeah, hi, thank you. It's a brilliant panel. So I was a banker also, so now I moved to the crypto field. I have a question for Seth and Itay. So I heard that there was a deal this year for digital bonds. Goldman Sachs, Santander, and Societe Generale issued digital bond, and the settlement bank was settled this in digital currencies. And settlement bank was the Bank of France. So my question is, like, I heard that Bank of New York doing some kind of stuff. So the question is, Itay, what do you think? Can this instrument issued by the Citi maybe next year? And question to Seth, I mean, what do you think about a risk assessment of such instrument? Can we put something exotic there, like NFT collateral, so we could do a pipeline between institutional investors or retail investors, in my brave dreams, to substitute ICO instruments on digital bonds, so way we can support creative industries.
So maybe I'll take the first bit, right? And I'm here in a personal capacity, so I can't talk about Citi's plans, et cetera, but let me touch upon settlement risk, because I'm really passionate about this particular topic. This is a solved problem. Thank you to everyone in crypto. Let's go and unlock all of this capital that is sitting trapped in these processes to the betterment of businesses and human societies, like kind of getting on with it. And if I think about, like, we will remember not in many years the absurdity that you're going to send me 400 million euros about right now, maybe a couple hours ago. I'm going to hold them. It's great. And you're going to wait until about 8 p.m. London time, and then I'm going to send you, $300 million. Yeah. And how crazy a system that is, like the anchor of a lot of the financial settlement system. How we solve that, which protocol, which group, which organization, et cetera, that's the detail that everybody is working on now. So those things I think we will solve, and it'll be for the better of everyone. Crypto, non-crypto, fiat, equity, bond. That's what we should be doing. We should be looking at these puzzles that have very honest intersects across everything.
Yeah, I can chime in actually really quickly, because I was part of that deal. There were 3 banks. I was the one who flew to Luxembourg and gave the pitch to the EIB. So, generally speaking, that innovation, I think, there was a primary market innovation, right? It was an investment banking innovation, right? And in order for you to, in the secondary market, trade things, you need to issue them in this native context, right? So you had an actual native bond issued on public Ethereum. You had it actually paid for and settled with a prototype of CBDC from the Bank of France, the digital euro. It's going to take many, many more of these things for this to come about. I think we all sort of believe in the T=infinity, that all these assets are going to be tokenized, they're going to be blockchainified, they're going to be doing interesting, new, novel business models. But all of these things are going to be slow. I think all these things are going to take time. And I think you do have these large institutions that are very much looking to get into this, and they're looking for clarity from the regulators to say, like, what can we do, what can't we do? And the real challenge there is just having those conversations, and that just takes time.
And the quick answer on the NFT side is we absolutely think that NFTs are starting with collectibles and art today, but they're very much a core DeFi primitive. This is an area that we're investing a lot in on the venture side. I think one of the core representations will be creditworthiness. We were having a conversation about this a few nights ago, so absolutely.
Brilliant. And unfortunately, guys, the flashing display in front of me is telling me I don't have time for any more questions and that we need to start wrapping up. I want to thank everyone on the panel for joining us and having this discussion. I think it was fantastic to discuss this, and I really hope that as much as there's a friendly rivalry between the two spaces, I also hope that actually by taking the legitimacy from TradFi and the new ideas from crypto, we can make both spaces bigger and better and bring the benefits to everyone. Thank you all.